Okay, good morning, guys. So let's get this briefing underway. So, just looking at some daily charts here. I mean, just looking at these charts, I mean, we've got the obvious patterns, and certainly with crude oil, and we'll talk about that in detail in a second. Obviously, this has been really the lead market of the week, and well, in many ways, of course, the lead market of the year. So a couple of big steps lower Monday, Tuesday. We're stabilizing a bit now, and actually WTI just edging back above 30, but we'll talk about that in a second. I think the most interesting picture in front of you here is probably the Bund. I mean, this is just exponential. I mean, it's stratospheric, quite extraordinary, with yields obviously dropping sharply as price drives higher. This is all-time highs for price for Bund futures, and we've had the Bank of Japan make a move at the end of last week to negative rates. We've got, if you're looking at Fed fund futures now, well, probabilities are that actually it's now less than a 50% chance we get even one rate hike in 2016. There's now less than a 50% chance. So most likely, according to those Fed funds futures, we will not see another hike this year. You've only got to go back, literally sort of 6 weeks, and the Fed were telling us March, and we were beginning to think they were right. How things change, 10-year yields in the US are down at the lowest they've been since April last year, down in the 1.8%. It's incredible. Like Japanese, after the news last week, Japanese yields are negative out to 8.5 years. You got Swift 10-year bond in negative yield. Deutsche Bank's Reed was pointed something out. He picked up a headline on Bloomberg yesterday. There's $7.1 trillion of debt in this world in negative yield. So quite amazing, and really it's been the feature of the year. The risk-off theme of the year has certainly led to the safe haven bond markets driving very, very, very strongly higher. What I would say is interesting, though, I mean, yesterday we had a big move, of course, to the downside for oil, triggered a big move for the downside for equities, but actually bonds hardly moved. So is there a bit of fatigue up here? I don't know, but it's it really is exponential. But that Monday's top so far enough. I mean, it's difficult with the Bund because if I just take this back, I mean, we've never been here. So it's difficult trying to pick out, here's my continuation chart on a monthly time frame. There aren't any levels. So it's hard to kind of, you can try and put in trend lines and I don't know what, but ultimately, there's nothing in the way. So you've got to work off these kind of handles. So 163, 164, and pivot levels, of course. But other than that, it's a difficult one to kind of pick any price point.
Next up, in 10 minutes' time, we do have the release of the Italian services PMI expected.
So around there, just mentioning we got some PMI numbers through the morning. Let's just have a quick look at the calendar, actually, before we talk about oil. We've got PMI numbers throughout this morning from Europe. These are all final readings, though. So just be aware, we had the preliminary numbers for January a couple of weeks back. These are all the final prints, culminating with the EU total one at 9 a.m. We've got Germany before that at 8:55, France at 8:50, Italy at 8:45. We've already had the Spanish numbers. It dropped at 8:15, and Spain delivered a better than expected services number at 54.6 and an overall composite reading better than expected at 55.3. Although that the Spanish services number, even though it was better than expected, it was the lowest since December 2013. So just be aware of that, even though it did beat expectation. We'll see. I mean, but yeah, the German one's probably going to be the one of most interest. We are expecting a reading on the services of 55.4, so unchanged from the preliminary number. Here's the chart. That puts it up there. This is good readings. Anything above 55 is certainly nice and solid. If you look at like the 10-year average, then we have been up higher than this back in sort of 2014, but in the main, well, I don't know, it's hard to get a trend out of that picture. We're kind of sideways and we're edging up towards the top end of the range, you might say, of the last few years. So generally speaking, these PMI numbers from Europe have been strong. This is one of the reasons they're trending higher. This is one of the reasons people are, more positive about Europe than, let's say, the US. We'll talk about the biggest data of the day in a minute. I think, for me, the biggest number is going to be the ISM non-manufacturing data. We'll talk about that shortly. We've got UK PMI numbers as well coming at 9:30. We've got Eurozone retail sales data at 10 o'clock. Then into the afternoon, it really is a very busy day for news flow. We've got ADP employment report at 1:15, expecting a 193 print after the very strong 257. This is the good, a warm-up for payrolls on Friday, of course. Just check the chart. 257 last time was a big, big reading. And then, of course, we got a really good reading on payrolls 2 days later. It's not always a good lead indicator, this, but it has been over the last couple of months, I would say. Strong numbers on ADP, and we've definitely had strong payrolls numbers. But this 257 was a mammoth print. If you look at the 10-year average, then that's right up there towards the top end of that 10-year range. It doesn't get much better than what we got last month. So ADP was very strong. We are looking for it to slide back below 200 though. There is nervousness here, of course. How much of that quarter four job creation strength was seasonal? What kind of impact is this kind of very negative start to the year for financial markets? Is this going to have an impact on confidence and therefore hiring? We'll see. Very important, of course, with regards to Fed rate hike expectations. But obviously the payrolls number on Friday is going to be the big one. This might give us a bit of an insight. 3 o'clock ISM non-manufacturing, 3:30 Department of Energy oil numbers. Massive day for data. This ISM number, I think, is very important. If you're worried whether the US is late cycle and it's going to tip into a recession in 2016, when I think actually this is the number you need to watch. I'm going to show you a chart. It's old, but I'm going to show you it anyway. It hasn't been updated. I need to get my Bloomberg expert to update this chart. But what we have on this chart is a divergence. It's old because this is back like wow, very old. Sorry, it's actually September. But the divergence is still there. What we've got is a measure of the ISM non-manufacturing, that's the top line, and the ISM manufacturing, that's the bottom line. We've got a massive divergence here. Now, the bottom line, that's manufacturing number, has gone further lower. In fact, we're obviously below 50. Let me just show you the chart of that. This is the manufacturing data. We've been below 50 4 months straight. We had another print on Monday, 48.2. Okay, this is bad news. However, what's offsetting that bad news on the manufacturing side is good news on the services side. And this is helping to maintain growth in the US, albeit slow. Now, this divergence can't last. You can see the correlations, well, it's messy, but very rarely do we have divergences for very long. And this is incredibly unusual. In fact, we've had a record ever divergence in terms of the distance between the two readings. Now, it can't last. It's got to converge again. But how is the convergence going to happen? Is the services number going to drop down to meet the manufacturing number at or below 50? If so, recession. Or is the manufacturing number going to lift and recover and move back up to meet the non-manufacturing number? If so, fine, recession avoided. Or are they going to meet somewhere in the middle where it will be less clear? At the moment, the manufacturing number is bad and stays bad. The services number, this is the chart. The last couple of readings, we've dropped off again. Sorry, the scaling on this chart isn't working. There we go. Now you can see the scaling. So look, we were up in the 59s in October. Very, very strong readings. The last couple of readings below 56. What we're expecting today is a reading of 55.1. This would put it at the lowest reading for 12 months. So actually at the moment, the services number is dropping to meet the manufacturing number. This is not good. Anything below 55 here and the recession fear is really going to start to grow. Okay, so I think this is a very important reading. So plenty of action on the data front. Of course, we've got oil inventory numbers. These are hitting the wires not until 3:30, of course. We're expecting a build of 3.75 million barrels. Let me just check. We had API report on their numbers last night, of course, as usual. Let me just get the numbers. Hang on. So we got a build of 3.8 million, which was lower than the expected 4.8 million, and a long way off last week's just extraordinary number of 11.4 million. This has helped to settle things, I'd say, this morning on oil. Let's have a look at crude. We definitely got this downward trend theme going. On Monday, crude dropped 5.95%. On Tuesday, crude dropped 5.5%. And, just massive scale movement here. We're 10% down on the week. It's only Wednesday morning. We have balanced a little bit, or stabilized perhaps I should say, and we're at just above 30 at this point. We've had that Russia comment. I mean, this has been the theme of the week. What led to the move higher last week was, rumoring that maybe there's going to be some kind of coordinated production cut. Plenty of rumors flying about Russia and OPEC were going to do a deal. And of course, over the weekend, OPEC rubbished those rumors. And so this is why we've had such weakness this week. But then you got more, headlines coming again this morning. So, I mean, I would say that these headlines this morning are, not as significant as the ones we had last week. I mean, obviously, OPEC have already rubbished these claims. Russia are still saying the same thing, that essentially, we're looking to do a deal with OPEC. But until Saudi Arabia, the comment this morning off Lavrov was that Russia is ready to meet OPEC if consensus is reached. But consensus hasn't been reached. So until it has, no cuts. But we'll see. We've had a bit of upside this morning. But we're kind of trying to test this low point we had on the 27th of January at the moment. This move lower yesterday on oil certainly drove the big sell-off on equities. We had a big move lower yesterday. The S&P dropped 1.8% in the end. We have a look at a 1-hour chart. Again, we've kind of lifted this morning as oil has lifted. The correlation over the last 24 hours has been phenomenally strong. Equities to oil, just up to test the pivot on the S&P at this point. So just giving back some of those gains that we had from last week. So on the currency front, I mean, euro dollar remains trapped. I mean, it's just sideways. Perhaps looking at all these markets on my screen here, the most subdued, the most unspectacular chart definitely is euro dollar, as it continues to be tracked, and we continue to wait for guidance. I mean, it's interesting you're not getting dollar strength, even though the probability of a rate hike in 2016 is now below 50%. And yet the dollar doesn't want to weaken off that. We're not getting any movement to the upside on the euro dollar. We've got a key barrier at the 110 handle. Look how many times over the last month, repeatedly we've hit 110, and it's just always been that barrier too far. And of course, we've got a weak dollar, perhaps as a result of our expectations there's no hike this year. But then when Draghi's promising more again, well, you kind of got a weak euro as well, and we're kind of just sitting and waiting and seeing. I mean, we're not quite sure where this currency pair goes from here. We need the next central bank action to kickstart this market and get some kind of directional movement going. So it's definitely still range bound with the 110 handle, the barrier on the upside. Right, so we just had Italian services numbers hit the wires. Let me just update you on that, and then I'll leave you to it. So we get France at 850, Germany 855, Europe at 9, UK at 930. Services PMIs throughout. We get the Eurozone retail sales at 10. So it's a busy morning. On the Italian side, slight disappointment here. On the services, 53.6. We had expected 54. That's a pretty big drop from last month's 55.3. So on the composite, 53.8. Yeah, it's a pretty big drop from 56 that we had previously. So slight disappointment here on some of these services PMIs out of Europe, but at least you would say, overall the composite readings are, still a decent amount above 50, albeit lower than last month. Okay, so let's see how we get on. For now, just a little bit of a bounce from yesterday's sell-offs in equities and oil. Keep your eye on crude. It's new highs right now. Crude making a new high. The pivot's the barrier to the upside. So as oil moves high, you're going to see equities favor the upside. And as it stands, the bunds are selling off in response. And we've been down to make new lows and test the pivot on the bund. So let's see next data in 2.5 minutes, French PMI.